Welcome to the Form Filling USA YouTube channel. If you're joining us for this explainer, you already know we absolutely love a good deep dive into the paperwork that literally runs our financial lives. Today, we're tackling the undisputed heavyweight champion of tax forms, Schedule A. Our goal with this explainer is to completely demystify the tax code. We're going to help you maximize those returns, keep way more of your hard-earned money, and most importantly, do the whole shebang without running afoul of the IRS. So grab your paperwork, get comfortable, and let's jump right into it. Right out of the gate, the foundational dilemma every single taxpayer faces when they sit down to file is pretty straightforward. Do you just take the standard deduction, or do you roll up your sleeves and tackle the paperwork to itemize deductions on Schedule A? Look, for a lot of us, the standard deduction is the easy, frictionless path. But as you'll see today, choosing the easy path might literally mean you're paying more tax than you legally owe. Sometimes you really just have to do the math to see if your specific expenses outweigh that standard flat rate. To keep things moving and totally painless, we've broken this down into 5 distinct chapters today. First, standard versus itemized deductions. Second, deciphering mortgage interest. Third, navigating the SALT cap. Fourth, charitable giving. And fifth, disasters, theft, and medical rules. Okay, Chapter 1, standard versus itemized deductions. Let's get into it. Now, you might be thinking, hey, I'll just pick whichever one saves me more money. Well, actually, scratch that. What's really interesting here is that sometimes the choice is made for you. According to the 2026 KPMG Personal Tax Planning Guide, there are specific constraints that force certain taxpayers to itemize on Schedule A regardless of what they'd prefer. For example, if you're married filing separately and your spouse itemizes their deductions, you've got to itemize too. You're locked in. The same exact rule applies if you are a non-US citizen for the full year, or if you're filing a return for a period of less than 12 months due to a change in your accounting period. If you fall into those buckets, Schedule A isn't just an option, it's mandatory. Moving right along to Chapter 2, deciphering mortgage interest. So the crucial point for homeowners is this massive number right here, $750,000. Under current IRS rules, you can only deduct the home mortgage interest on the first $750,000 of indebtedness. And just a heads up, that cap applies if you're married filing jointly, but it drops to $375,000 if you're married filing separately. Now, keep in mind, this specific cap applies to loans taken out after December 15th, 2017. But what if you bought your house before that? Well, the limits actually change depending on when you bought your home and what kind of loan you have. If your loan is from before December 16th, 2017, you are grandfathered in with a much higher limit. You can deduct interest on up to $1 million of debt. But listen, be super careful with home equity loans. You can't just take out a home equity loan to, say, pay off credit cards or buy a boat and then write off the interest. No way. To be deductible, those funds must be used specifically to buy, build, or substantially improve the home that secures the loan. Oh, and one very quick reminder, if you're hunting around for the deduction for mortgage insurance premiums, PMI, that has officially expired. You can't claim it anymore. And speaking of interest, this brilliantly illustrates a related point regarding investment interest from our featured expert, CPA Logan Alec. If you have investment interest that actually exceeds your net investment income for the year, you can carry that deduction forward to the next year on Form 4952. But, and this is a huge but, as he warns, if you switch tax software or hire a new tax preparer, you have to manually ensure that carry forward number comes with you. The software doesn't magically know your financial history, so you really have to keep your records tight. All right, let's turn to Chapter 3, navigating the SALT cap. Based on data from USA Facts and the IRS, the allowable Schedule A deduction for these state and local taxes is strictly capped at $10,000 per year. And if you're married and filing separately, that cap is sliced right down the middle to $5,000. So whether your property taxes are $8,000 or a whopping $28,000, you are only allowed to claim up to $10,000 in total SALT deductions on your federal return. To really understand why this matters so much, we have to look at what this deduction actually does. The SALT deduction is basically just a mechanism to ensure you aren't hit with double taxation on the very same income at both the state and federal levels. You're essentially taking the money you already paid to your state or local government for income, property, or sales taxes and subtracting it from your federal taxable income. It's an absolutely fantastic benefit, but man, that $10,000 ceiling makes it a major limiting factor for taxpayers living in high-tax states. Chapter 4, Giving Back. specifically looking at charitable contributions. So here's the golden rule when it comes to philanthropy. You can't just hand cash to a friend in need or donate to a political candidate and expect to claim it on Schedule A. It doesn't work like that. The IRS strictly limits deductions to official qualified organizations. This includes government entities used for public purposes, war veterans groups, and organizations operated exclusively for charitable, religious, or scientific purposes. On the flip side, it strictly excludes personal gifts to individuals, political lobbying groups, social clubs, and, unfortunately, your local homeowners association. So how do you actually know for sure if an organization qualifies? Well, as CPA Logan Alec noted with his hypothetical search for Save the Whales, Inc., you don't have to guess. The IRS actually provides an online tool called the Tax Exempt Organization Search, or TEOS. You literally just type in the name of the charity, and it'll give you a stamp of approval verifying their eligible status. Always verify before you assume a contribution is tax deductible. Now, what if you're donating physical items instead of cash? Say you're giving away a really nice, rare vintage record collection, or even a car. The amount of paperwork scales up directly with the value of the items. First, you have to assess the fair market value. And let's be real, used clothing almost never holds its original retail value. If you claim a non-cash gift over $500, you're required to attach Form 8283 to give the IRS more details. And if the gift's value is over $5,000, the IRS generally mandates that you get a qualified appraisal to prove it. Simply put, the higher the value, the higher the scrutiny. And that brings us to our final chapter, Chapter 5, Disasters, Theft, and Medical. If the worst happens and nature strikes, causing property damage, you might be able to claim a casualty loss, but you can't just claim a loss for a localized bad thunderstorm. The loss generally needs to be attributable to a federally declared disaster. When you sit down to fill out Form 4684 to report this, the IRS requires precise FEMA identification numbers. For example, if you were impacted by the Arkansas severe storms, you would literally type in DR 4865 right along with the zip code of the most affected property. Accuracy here is absolutely vital to getting your relief. Now here's a massive update for you. The tax code is constantly evolving. Under the recent 2025 legislation known as the One Big Beautiful Bill Act, there are 4 brand new deductions: no tax on tips, no tax on overtime, no tax on car loan interest, and an enhanced deduction for seniors. But here is the real kicker. You actually claim these on the newly created Schedule 1A, not Schedule A. And if you're eligible, you can claim these really powerful new deductions even if you already itemize on your regular Schedule A. It's a real game changer. Finally, before we totally wrap this up, an important warning straight from the IRS instructions. Let's say you realize you made a mistake on your Schedule A, missed a carry forward, or just completely forgot a charitable deduction. You can fix it by filing a 1040X amended return. But be prepared to wait. The IRS cautions that processing amended returns can take up to 16 long weeks. So clearly, the goal is always to get the paperwork right the very first time around. So as we close out this Form Filling USA explainer, I really want to leave you with this final provocative thought. Are you leaving money on the table, or are you just avoiding the paperwork? Yes, the standard deduction is super easy, but understanding Schedule A, knowing your mortgage limits, tracking your SALT cap, verifying your charities, and catching those branding 2025 deductions, that is exactly how you take back control of your financial life. Don't let the fear of some IRS jargon keep you from maximizing your returns. Dive right into the forms, do the math, and keep what is legally yours. Thanks so much for learning with us today. See you next time.